Hello everyone, this is Mark with Semantics Research with your market recap. Today we had a huge gap down in the markets after the weekend, and immediately in the IB session we immediately began selling off until buyers stepped in the 3750s, and the market rallied for a bit before people realized they did not want to be long and sold a rally. Crypto continues to be decimated, proving that it is a risk asset and it is not an inflation hedge or gold proxy. It is rather moving quite similarly to a very high beta NASDAQ stock. We must keep in mind that many players are leveraged in crypto and there is poor liquidity in general, so there could be a huge extension to the downside as players run to the exit, and we might see massive liquidation breaks in the near future. VIX had a nice upward move as the market meltdown continued. Keep in mind that most bear markets do not end until VIX pushes above 45. If we take a look at the dollar index, it is strengthening relative to the other fiat currencies. Mind you that the dollar is still losing value due to high inflation, but is holding relatively strong versus others. The dollar being bid and yields moving higher is quite bullish for oil, which we see is pushing up to the highs. The issue is also in the supply side, where policy is discouraging oil production as producers do not wish to get burned. As long as the war is prolonged and the sanctions continue, we will probably see pressure to the upside in oil. With oil being elevated, we do not see inflation being tamed, and we are likely to go into a deep recession. You see inflation printing a 4-decade new high, which scraps the whole peak inflation narrative, and we are edging closer to stagflation, with hot inflation numbers and consumer sentiment being at an all-time low. And one could draw a parallel with the 1970s, where stagflation was prevalent and oil ran up for about 7 years. During this time, energy companies made up 30% of the S&P 500 before peaking in the 1980s. Currently, oil companies make up about 4% of the S&P. And the only really serious solution to this issue is that we increase production to offset the high demand that is currently outpacing the current supply, but with the current politics, that is not reliable. We are shifting from a low inflation environment to a high inflation environment as the genie is out of the bottle, as Asweth Damodaran says. Investors should not expect the Fed to solve inflation without putting the economy into a deep recession to kill demand. The main concern is that where do the long-term inflation expectations settle at, and the 10-year rate continues to push higher. And in this environment, young tech companies with negative cash flow and poor business models will continue to be killed. We must realize that this growth cycle is quite different as major areas are facing headwinds. For example, China has serious issues with COVID lockdowns, Europe is facing recession this year, and the US is slowing down. This growth scare should be taken seriously, as this is a result of central banks falling behind the inflation curve, and it is likely we will see high inflation to the next year and further while we contract in growth. We are seeing a global economy that is being rewired by geopolitical and government intervention and people in the real economy. We will continue to see a world with fragmentation in the global economy as we decouple from globalization. It is also quite too early to say that inflation has peaked, as we are seeing inflation broadening in the economy due to the Fed policy mistake, pressures on shelter and food, and energy prices going through the roof. The Fed must hike rapidly in order to deal with high inflation, but then has to deal with credit risk. Core CPI being up is extremely bad, as it does not bode well for the economy, and we will likely see the June CPI numbers be even worse. According to the Dallas Fed, the Ukraine war has resulted in the largest supply shortfall since the 1970s, as 3 million barrels a day of petroleum production was taken out immediately from the global markets. keep in mind that Russia is a major oil producer, which accounts for almost 10% of the world's oil production. And we are seeing supply shocks due to this refusal by financial institutions to back transactions, oil tanker rates for Russian destinations rising to record levels, and oil companies also avoiding Russian oil in fear of official sanctions on exports at a later date, as well as attacks on vessels in the Black Sea. Also, Russian natural gas amounts to much of Europe's imports as it is used for home heating, power generation, and industry. It plays a central role in production of fertilizer, which can lead to higher prices in agriculture, as well as Europe relying on Russia for 40% of its coal supply as well as uranium. This affected area also surmounts to 29% of the global wheat supplies, which many geopolitical hotspots rely on. There are many fears that there could be also another event like the Arab Spring due to many of these geopolitical hotspots relying on Ukrainian wheat and grain. As long as the war is prolonged, and it could mean that the supply of grains can be curtailed long-term past 2022, and this in turn could drive up the food prices and reinforce contraction in growth as well as inflationary effects, as well as the global economy. As a result, the global economy will see a delay in the shift to renewables, and the surge in costs in fuel, electricity, natural gas, and food will continue to keep inflationary pressures high, as well as Russian exports being off the market in the long term, which will result in global economic downturn. If you take a look at Russian exports, which can constitute 10% of the exports in the world, if we take a look at this chart by International Grains Council, we could see that Russia and Ukraine account for a quarter of the global grains trade. And we are seeing fears over sanctions leading to a sharp drop in supplies, which contributes to the global food costs. Prolonged fertilizer shortages can negatively affect next year's crops, and 25 million tons of Ukrainian grains and commodities are still stuck in Ukraine due to fears of attacks on the shipping lanes. Now, if we take a look at investment-grade bonds, we are moving down to COVID lows, which does not bode well for the markets. And we must pay attention to this because if there is excessive leverage taken in investment-grade bonds, then this is when you see finance contaminating the economy. A lot of key events this week with the FOMC and massive OPEX amounting to $3.2 trillion in options as well as VIX expiration. There is a possibility we might see some sort of rally into into options expiration as put protection is cleared. And you have to remember that this market is driven heavily by put buying and put selling. If you take a look, the market is now betting on 75 basis points of rate hikes in the next two meetings as the Fed is behind the inflation curve massively. This puts us at the perceived neutral rate, or the Goldilocks zone, where the rates shouldn't be constricting nor stimulating. I think the Fed will need to go over the neutral rate to deal with inflation, and perhaps we'll see a Volcker-style moment. If we take a look at shipping costs, there are projections that port congestion should ease into the next year as new container vessels are delivered and demand from shippers softens from pandemic highs. But this will not be enough to restore the global supply chain flows to where they were before COVID. And it is unlikely to see low shipping rates as infrastructure planning is uncertain due to uneven reopenings. And we could see some easing of port congestions as workers fill vacancies from the pandemic. But with the COVID-0 situation in China, we will continue to see stress on the supply chain. We also see worsening congestion in the European ports due to more vessels arriving from Asia, while there's a trucker strike in South Korea that could further exacerbate the supply chain issue. And that is it for today's market recap. I want to thank you all for watching, and be sure to check out the link in the description for more updates, and as well as a link to our Substack.